Welcome to our special year-end Best of 2020 episode of the Wealth Management Today podcast. I'm your host, Craig Iskowitz, and I run a consulting firm called Ezra Group. We're experts in everything related to WealthTech, and this is where I usually give our standard marketing pitch, but instead I'm going to sneak in a plug for our market research team that has been doing some incredible work led by our head of research, Gene Sullivan. If you're running a fintech firm and looking to expand into new markets or develop new products, you're going to need data and insights on the client segments that you're targeting. You absolutely have to know what prospective clients are looking for, the size of the obtainable market, the revenue potential, who the top competitors are, and any functionality gaps that need to be addressed. You can get all this and more from Ezra Group's research team. If you're a member of the executive team at a growing fintech vendor, contact Ezra Group right now by going to our website, ezragroupllc.com, and click on the big button that says Schedule a Complimentary Discovery Session at the bottom of the homepage. Now, before we start the show, remember to subscribe to this podcast wherever you listen to podcasts and give us a 5-star review on iTunes. Myself and everyone on the WM Today production team will be very appreciative if you do. Our content team has pulled some of the best clips from the best episodes during this year for your listening pleasure. And there were so many of them that they couldn't fit them all into one episode. This is actually part 2 of our best of 2020. You can check out part 1, which was posted, I believe, back on October 22nd. So scroll back through your timeline and you can find that and listen to that anytime you like. And check this one out. We've got a really great lineup of clips from the best guests we've had on the podcast. We have, first up is Babu Sivadasan from Jiffy AI, talking about hyper apps and low-code development and AI, some of the things they're doing at Jiffy.ai, really, really interesting stuff. Next up is Lex Sokolin, and he's the FinTech heretic. He does a really great rundown on East versus West FinTech and how the battle is going on between these two regions and how it's shaking out. Then we move on to Sean Brown, the CEO of YCharts, great product portfolio analytics tool, client communication tool, how they're expanding, building out their capabilities into separately managed accounts, which is really a cool thing for a lot of financial advisors who will need that. And I think the next one is Rian Horgan from Silver, a really interesting app for retirement, which I thought was very interesting. I actually signed up myself and got into it. And we talked a lot about retirement and how fintech apps can help people retire better. And finally, last but not least, Aaron Shum from Vestwell, talking about the tech stack for retirement plans that he's building over at Vestwell and some of the insights they gained from their retirement trends report. So please take a listen and let us know what you think. Post on social media which one of these guests and the clips was your favorite. Look forward to talking to you again on the other side. And our first guest on this Best of 2020 edition is Babu Sivadasan, CEO and co-founder of Jiffy.ai. I've known Babu for quite some time. One of the first people I met in the wealth management industry, in fact, way back in 2005, 2006, when he was working at Envestnet, actually a precursor to one of the firms that Envestnet merged with before they became Envestnet. He was with Envestnet 20 years, and then 2 or 3 years ago founded this great company called Jiffy.ai, doing some really cool stuff with robotic process automation and what they call hyper apps. Very interesting stuff. You should really check out their website, Jiffy.ai. Look at some of the things they're doing with customer service, other process automation, KYC, transforming finance and accounting, invoicing, lots of what sound like mundane processes, but big business, tremendous scalability across industries. I really hope his Jiffy.ai takes off and does really well. A lot of great work can be accomplished. So take a listen to this clip from my interview with Babu. Moving on to, so we talked about hyper apps. You have another product that you call Innovate. This is the one I think is really valuable, and I'm really interested in this, being a former programmer. that you're reimagining software development and having the system generate its own code. How are you doing that, and how is that better than a real programmer doing the code?
Where it is really different, the value add is, we every line of code that we write, we introduce the possibility of bugs, so as we speak right now, there are thousands of people out there, writing, introducing bugs into the software that, because we bring new people in all the time, and we are repeating the same set of mistakes, same things that we have solved before, or you don't know that you have a piece of functionality that is already in there, but you're still building it, because you don't know that a new person coming into the team doesn't know about it. So software development, especially enterprise application development, is fundamentally broken that way. Whereas, if we were to let systems do that, they have that awareness, they have that digital blueprint of the entire ecosystem, entire application, that digital twin, if you will, right? So with that, it knows, if you're looking for a new piece of functionality, it will automatically bring up that set of choices, that already exist, that you may have already created. Being able to, write self-tested code, automatically, being able to, so you're taking this to a paradigm, a much higher level, where you're talking in terms of the needs, that you're trying to solve for, and let machines interpret that, so we have heavy capability in natural language understanding, so we are able to read those instructions in plain English, right? And why do we have to write code? Because machines didn't understand your own way of expressing things. So you had to learn machines' way of doing things, right? And now we're talking about machines have gotten to that stage where we can, with technology, enable them to think like us, or enable them to interact and take things, that are native to us, and have them be interpreted rather than the other way around, which is supposed to be the way, which is what we always wanted, right? So it's finally getting to be a reality.
Mm-hmm. But isn't it true that the AI is just simulating human thought? Or is it really having its own thoughts?
Yeah, no, it's really having a series of small innovations, that you put them together, and that's what contributes to that capability.
Let's talk a bit about this year you guys raised $18 million in a Series A. So congratulations.
Thank you.
You've done a lot with the company in a short amount of time. How is that this latest funding raise going to help the firm?
Yeah, so what we do takes a lot of capital, right? We are putting out groundbreaking technology. That takes a lot of effort and a lot of engineering, a lot of technology investment that is necessary to do that. And we have been fortunate to get that first round of capital. That was, essential to, invest, and build a team out, build a strong technology team, technology capability, and things like that. So, we are in that. We've done that. We are serving clients today. We have 30 plus clients. 10 Fortune companies as clients. So we are in that. Just getting our technology out there, and customers start leveraging the value of it, and getting to that next step of the evolution of the organization. And we've raised capital from outstanding venture capital firms, and a bunch of public company executives, and people who believe in what we are doing. And so the way we are doing this, we are taking on AI-based innovation with a deep sense of social responsibility. So we are a combination of a for-profit and a non-profit at the same time. We understand and recognize that what we do, disrupts the traditional jobs as we know it. It has the potential to. Any AI company is in a way dabbling into disrupting the workforce as we know it, and so it's been a good way to combine the two. So on one end, you can be disruptive, but then on the other end, you can also be compassionate about it. You can help invest in those people who might be potentially being affected, help them retrain, for the next set of jobs. So it's a very humbling experience that way to kind of try and do both at the same time.
Next up on this Best of 2020 episode is Lex Sokolin, who is the head of wealth management for Consensus. And Consensus is one of those crypto blockchain software companies maybe you've heard about in the news. They're a programmable blockchain software company. So they're based on Ethereum, which is part of it, which has got a programmable blockchain. And the way he likes to call it is it's a next generation computing paradigm. So they're looking to leverage blockchain and other technologies, crypto technologies, decentralized technologies for financial instruments, whether it's funds or trading or investments. They also work with something called decentralized finance, which I won't explain here, but please Google it. It's really interesting. I think it's one of the futures of where finance is going. And then using blockchain for large financial institutions. Lex always has great insights, which is why I love to have him on the program as often as I can. So please take a listen. The soup. Yeah, I liked your comparison of the Western versus Eastern model. So can we talk about that just a little bit more? Can you explain what you mean when you say that the West the question was, can the West integrate finance quickly enough versus can the East grow quickly enough? So why is it integration versus growth? Why do you see it that way?
Well, I think the West is starting from a very different place where behaviorally people don't really want to adopt new things. It's a friction, right? So I think large parts of the US are still swiping their credit cards, or they're still sending in paper forms to their financial advisor, thinking that is a reasonable thing to be doing. And the regulatory environment in the US is puts precedent and consumer protection first in a way that is largely blocking of what were they trying to prevent? They're trying to prevent Facebook destroying the banking industry, to put it into stark terms.
Yeah, so it's not consumer protection, it's their constituents protection, or the ones who are the banks that are giving them campaign funds protection.
It's, you use the words of one to do the other. So, we can revisit, for example, the reaction to the fiduciary rule, right? Like it was the kind of and I'm going to get this wrong too, but it's not it may be the Transamericas of the world or similar firms. The LPLs of the world might have had an allergy because they have commission-based businesses to the fiduciary rule, whether from the DOL or the SEC. Whereas, the robo-advisors were all about the fiduciary rule and thought it was good change. And it's it's this conversation about what does an individual need, what does a human being need to be taken care of, or to have the freedom to buy bad stocks for too much commissions. And so the conversation's about the consumer behavior, but behind that is really I think the incumbent interest. You see the same thing with the banking industry in the States. So, the OCC keeps trying to put out this fintech charter, which would let Square and PayPal and other, Stripe have easier access to holding people's deposits, and then local state kind of banking organizations just keep suing the OCC for overstepping its mandate. So I think that's just inherent in our society.
So we're running out of time, but I want to hit a couple more topics. So the news, I was looking at some news that Robinhood valuation hit 11 billion. Do you see that ever ending? Is there no end for that valuation? Is it going to hit a wall? Are people going to realize that they're not making any money day trading and it's going to fall off, or is it just going to keep growing?
I'm somebody that is, I'm somebody that comes from like an asset allocation and modern portfolio theory background. putting aside that none of the numbers work anymore, but regardless, like I diversify and hold, like sure, believe in that. So for me, Robinhood was always a sign of kind of selling candy, and especially giving away candy, right? So it's both delicious and addictive and bad for people in the long run. And so, I continue to believe that. At the same time, you have to observe what Robinhood has done, which is it has thrown so much money at user acquisition and training people in certain ways, that the net effect is retail trading is something like 40% of market volumes now. That's a 2 to 3x over the same as last year. I think COVID has played a large part in that because we're all trapped in our houses, and so everybody's in these digital experiences. There's also, I think, underneath the trading, sort of like um, this, it's not a sadness, but it's everyone is trapped in a terrible financial situation. So, when what do CEOs of failing companies do? They take out a whole bunch of debt that the firm cannot possibly repay, but it's like the moonshot, to try and get out of it. And so I think for a lot of Americans, this is why you buy crypto assets. This is why, you take out too much lending. It's because you have no choice. You're in such a hole that you need something to give you a narrative to get out of that. And I think Robinhood has uh, amplified that to such an extent that it eradicated the previous industry equilibrium around, commission pricing. And so there is no commission pricing anymore for anybody. And then it exposed, it generates 600 million in revenue. Like it's or $1 billion in revenue. It's not a fintech struggling to make money. But what it has, where does that revenue come from? The revenue comes from high frequency trading shops that act as market makers in capital markets. What does that mean? It means that they buy and sell on both sides, and they take a spread in between. They don't take really exposure to any asset. They do it really fast, and they get retail flows from one side, and that gives them liquidity to close out trades on the other side. And you can have super funky outcomes. It's the equivalent of advertising for Google, right? Selling the product of attention. In this case, it's selling the product of order flow. And so I think Robinhood, we're in a transition to a different equilibrium for equities. And I think that transition benefits Robinhood in a strong way and makes it much more difficult for firms that want to be fiduciaries, and want to do well by the client, because the only revenue pool sort of left is either cash accounts and interest on that, which is very low, or trying to incentivize payments through interchange, and then or trying to incentivize trading, and kind of churn in an account. So I don't think there's necessarily a cap on that, to answer the question more directly, and I think that's at the expense. It's like a social cost that has been born as a result of that.
Can you give me a 1-minute answer? Why are you a fintech heretic?
Why am I a fintech heretic? I must get bored easily, and so I always look for what's the edge. Where's the place where people are breaking the thing, and reimagining how it could be. So even in a situation where 99% of the industry is the same, I'm always going to look at that 1% that is behaving in a different way. And so this is why I'm interested in DeFi. This is why I'm interested in how crypto assets repackage financial instruments and repackage asset allocations and automate all the things about actually manufacturing the financial product, how they break global regulation, how you custody and hold them in a different way. And I think, we as people have only so much time to spend, and for me, spending my time on things that are curious and different is where I get the biggest payoff. So that's always been my frame.
This next clip, I really enjoy talking to this person. This is Rian Horgan, the CEO of Silver, also Kinder, which I think is their parent company. And I think 4 years ago, when she started Kinder/Silver, after 17 years at JP Morgan, where she had done a lot of things for them. I think she was head of derivatives in Europe, and moved up in the industry, in the business, and was head of a lot of parts of JP Morgan. I don't have her LinkedIn in front of me, unfortunately. Please take a look. But what I really liked was the way, part of her story is that she was looking for her identity when she left JP Morgan and wanted to start her own business, but people didn't see her as being someone to invest in, which could be a gender issue, could be an age issue, since she was almost 40, didn't have a co-founder. People tend to look for, PE firms and VC firms look for the young, hip kids to put money into, and us older people, they don't see us as investable, as Rian found. And she finally found a couple of firms that took a chance on her, fortunately, and she's doing really well. One of those VC firms was Anthemis, which was one of the first funding rounds of Betterment. So these guys seem to know what they're talking about. And she also got a big stake from another firm. Where's my notes here? I apologize. A big stake from Penny Pritzker, who is a billionaire, the Pritzker billionaires, Inspired Capital, and Alexa Von Tobel, who founded LearnVest, so a successful entrepreneur there, who have taken a shot with Rian and her company Silver, which is a retirement app retirement app targeted at those age 55 and older, where she found is not really focused on by a lot of startups. So great conversation. Check out this clip with Rian Horgan from Silver. Indeed. Yeah, that sounds exciting. I can see how you'd want to jump right out at something like that. But you're up against a lot of competition. So I know in a previous interview, you mentioned you want to become the Apple Watch of retirement information rather than the Life Alert. So can you explain what you mean by that? Yeah, I think I know what you mean, but what do you mean by that?
So Craig, we were just discussing a little bit earlier. You described yourself as a baby boomer, but with tech habits that look more like Gen X. And what I would say to you is that's actually very indicative of our customer base, which is the vast majority of people underestimate how tech savvy this customer base is. This is a customer who grew up using technology in the 80s. My dad is older than you, but he's 70. He read CAT scans and MRIs on a computer at home in the 80s. And so this is a tech literate and a tech savvy community, but for some reason, the market looks at everyone over the age of 50 together as one big bucket of people. And so for the technology that generally has been built for the over 50 plus demographic, you have products like Life Alert, which are all about falling and not being able to get up. And I would imagine, Craig, that you have no interest in wearing a Life Alert. But
snowboarding.
Exactly. And
falling and can't get up snowboarding. But
right. But I don't know if you have an Apple Watch, but I bet if you did have an Apple Watch, it wouldn't be a signifier that you were old. And I think what we get really excited, okay, so no watch, but what we get really excited about is that opportunity to build inspiring, beautiful technology for this demographic that doesn't make you feel old, that actually just empowers you to live your next best act. And I think, we've spent a tremendous amount of time learning how to design for this demographic. There is a massive difference between how consumers in their 50s and 60s navigate technology versus consumers who are 80 plus. Life Alert is for the 80 plus crowd. What we're building is the Apple Watch for financial and health decisions in your 50s and 60s.
That's cool. That's a great way to describe it. And people need those kind of anchors to understand what you're talking about. You can say that you're an app to help people navigate retirement. That doesn't click. So you want to be the Apple Watch of retirement. Oh, okay, now I kind of see where you're going with that. So with that, there's a lot of competition in this space. There's so many apps. Now, I was just saying, I've got 1,000 passwords, my password manager. I've got hundreds of apps on my phone, although I'm probably way more than average person because I'm in the tech space. So I'm always trying things out. But lots of people have lots of apps, and there's lots of retirement savings programs. Every wealth management firm, every advisor has got these calculators. Every asset management firm, Vanguard and Fidelity, have these calculators and tools for retirement. How do you set yourself apart, knowing that all those other tools are available to your customer base?
Yeah. So the vast majority of modern tech apps have been built for accumulation. So it's for people who are saving for retirement. So it's learning how to pay down your student loans, accessing your first mortgage, putting money away maybe for your children's 529 plans. The reality is that our consumer is embarking on a different phase of life, which I would think about as decumulation. So all of a sudden, it's less about saving for, but it's about spending down your savings in retirement. And also understanding the financial consequences of a lot of decisions you're about to make. So, your election of Social Security, huge financial decision. Interestingly enough, your decision around healthcare, a very big financial decision. When healthcare costs on average a couple $280,000 over the course of retirement, healthcare in America is a financial issue for every single retiree. So what I think is really different about how we really approached building for this consumer is the first is that we're purpose built for decumulation. So we're helping you in that run up to that retirement decision, and then helping you as you start to draw down your funds. And the second thing is that we're built for what I would think about as modern retirement. So in the old days, you had a pension, you had income for life, and you actually probably were only living until your early 80s. Today, the vast majority of our customers don't have pensions. They will likely live into their 90s. And so really developing an ecosystem that's much more holistic to help the customer, we think is really important. So when I think about our customers, if they're in an offline world, they're talking to a financial advisor, an insurance agent, a Medicare broker, they're going to the Social Security website, they're talking to a real estate agent, they're talking to a lawyer. There's no one person pulling all that together for them. And so what we think about as the real opportunity here to simplify and empower these customers is actually to be that digital landing spot that pulls all the pieces together for them and can really act as their general practitioner. It creates a lot of anxiety for this customer to have to be the GP as they make all these decisions. But the existing ecosystem of incumbents is really set up to give you an advice on a sliver of the problem and really leave it to the consumer to make the decision.
I like how you put that. The existing ecosystem of incumbents is designed.
Well, that's a lot. Look, and I came from an incumbent, so I understand, which is, like, I often describe what we're building as this intersection of consumer tech, insure tech, fintech, health tech. Find an incumbent who wants to be in all those buckets. It's like, why would you want to be regulated like that, right? So we have the opportunity, because we're building from scratch, to really think about, like, how do we build an ecosystem that's built for modern retirement? But if you're a bank that's already regulated at the state level, do you want to now add insurance regulators to the equation? Do you want to add, Medicare to the equation? There's just a level of regulation and scrutiny that if you're an incumbent, you probably say, look, I'd rather just stay really good at what I am and solve this piece of the puzzle. But again, I think the challenge for the consumer is that with this shift from like DB to DC, where we just keep pushing more and more decisions to the consumer. And that's, when we think about what the app is really intended to do, is like recognize that all these decisions have frankly been pushed to the consumer. Now, how do we help bring it back together and help empower them?
That's something you don't hear a lot about, pushing decisions to the consumer. I think people, assuming that politicians were doing things for the right reasons, which is a tough leap to make, that maybe people aren't equipped to make these decisions with all the other decisions they have to make. You think that they're empowering people by giving them more control, but you maybe are, what you're saying is that are you saying you're overwhelming them with decisions that they're not equipped to make?
Well, look, I would just say for the average consumer, the math of Social Security is complicated. And so it's no surprise that the vast majority of Americans elect Social Security at the earliest point possible, which is 62. But as Americans are living into their 80s and 90s, that may not be the best financial decision, particularly if you don't have a pension or an annuity. So I think about Social Security as our customers' largest retirement asset. For most of them, it's the only asset that they have that has lifetime income or longevity insurance. And the reality is that most financial advisors don't talk about Social Security with their customers. It's viewed as a government benefit rather than a financial asset. When it's more than half of our customers' retirement income, it's a financial asset and it has to be included.
But isn't it both the government benefit and a financial asset?
Well, I would argue, like, you've paid into it. It's a savings program. You've paid into it, and the asset and the funds are there for you as you retire. But the mentality of it being a government benefit, I think, changes the way people think about taking that election. And so it feels like there's this risk that it feels like a handout rather than this financial decision you're making. And so our goal is to help you understand that it's a financial decision without overwhelming you. So how do we expose and help you see the power potentially of delaying Social Security? It doesn't make sense for everyone, but it may make sense for you, and help you understand how that impacts your financial plan. But do that in a way that doesn't require you to read 300 pages, right? That's just not realistic. And look, there's a ton of great content in those books, but those books are written for the 1% who frankly don't even need the Social Security. It's not written for the other 99%.
And next, the clip is with Sean Brown, the CEO of YCharts. Really enjoyed talking to Sean. I was introduced to Sean and YCharts by Trisha Rothschild, who was a former head of product from Morningstar and was on the board of YCharts and is now president of Apex Clearing. Congratulations, Trisha. Introduced me to Sean, and really liked having him on the program. A lot of interesting insights, not only about the portfolio analytics tools and the industry in general. You know, Sean's got a long history in startups. We have something in common, Sean and I. We both started out as software developers and then became strategy consultants. Although I kept going in the consulting area, and he moved into the startup world, corporate development, buying and selling companies, and finally he was working for ICE and then ICE, the Intercontinental Exchange, and then left there to become head of YCharts. So please check out this quick clip with Sean Brown talking about how YCharts is expanding their data coverage from just ETFs, mutual funds, and such into SMAs, separately managed accounts, which is really a big area of growth for RIAs. So you brought up a good point. Reg BI is just changing the way a lot of advisors do their business, at least on the compliance side. What tools do you have that advisors can use to help them in that area?
Well, we've got pre-canned analyses, which is a really big one, which is we know the things 80 to 90% of people who want to do a fundamental analysis or an exposure analysis or a relative merit analysis, we know what they're trying to do. And you put in 2 security names, stocks, ETFs, mutual funds, models, will help you compare the relative merits. To the point you brought up earlier, which I don't think I fully answered on SMAs. SMAs is something for high-end customers that advisors want to have as an option. And we just felt it was the right thing to put in and provide to them something that they don't want to have to switch to another tool to do SMA data. You know, we think the most enlightened advisors want to have access to a whole lot of different asset classes. They want to do some good solid analysis, but they don't want to start from scratch with a blank sheet of paper and, okay, how do I compare these 2 portfolios? And we think the best thing we can do is help them very quick and efficiently do these analyses, help them save off these analyses, and help them present these analyses to their customers to say, I've got your back. I'm thinking about this for you. Here's my proof points. Hope it works for you. Let's talk more. And you know, when they want to meet their regulatory obligations or need to prove it, they've got a really nice documentation trail that helps them do that.
Yeah, I think it's interesting you guys moved to SMA data. I mean, we work with a lot of enterprise firms, broker-dealers and banks, and they're all about separately managed accounts. It's very popular with their clients, especially on the wirehouse side. Huge users of separately managed accounts. So it's interesting that more RIAs are using SMAs, whereas the majority of assets in the RIA space has always been ETFs and mutual funds. So seeing them move into SMAs, do you think it's also the fact that there are more SMAs with lower minimums, no trading costs, the fractional shares gives other options for mass affluent clients?
Absolutely. Absolutely. You know, there's, we have access to over 10,000 separate accounts. Just saying 10,000 means there's a lot out there. And I've always found the laws of supply and demand tell you there wouldn't be 10,000 if there weren't ample needs and interest in them. The challenging part, whether it's you're talking about separate accounts or you're talking about models, is everybody gets those at the conceptual level, but how do you compare them, right? Models. There are 10,000 models out there in model marketplaces, and a lot of them look something like this is a 60/40. That doesn't mean they're the same thing, right? So how do you do your homework to compare two 60/40 models to know which one's right? And how do you know the exposures of those models? And how do you know the underlying securities? The thing we really like to see that our clients are doing in our platform is they are taking these aggregated things, whether those are models or those are mutual funds, which are comprised of, or ETFs comprised of a bunch of holdings, is saying, what are the atomic pieces of each of those aggregated things? And how can I look and see what is my exposure in these two different models or these two different SMAs? What's my exposure to big tech or FANG stocks? And we just find our clients really leveraging that functionality quite a bit and having very robust discussions with their customers afterward.
Yeah, I mean, I think a lot of clients don't even realize their exposure. They think, oh, I'll buy a little Apple stock, I'll buy a little Facebook stock because it's in the news. They don't realize how much they already own in every in all the any large cap mutual fund.
Hugely important. Hugely important. People have no idea how much exposure they faced in some of these things that look like well-diversified assets on their own. They may or may not be, and you or your advisor should do your homework.
Yes, they should, which is why they need tools like Y charts. One area we've seen a lot of movement in, well, every year it seems to get more and more, is M&A. The mergers and acquisitions and the amount of money coming into the space, especially not just buying RIAs and buying broker dealers, but buying fintech firms that service the wealth management space. We're seeing a lot of that. And you guys just closed your own deal. Can you talk a little bit about that?
Yeah, we were acquired by a private equity firm out of Philadelphia called LLR Partners, which is really a thrilling milestone in our journey. It's neither the end nor the beginning of a journey. It's a continuation that's going to help us grow the way we have an opportunity to grow in our future. So we're really excited about that. And broadly, if it's in a context of the advisor space and the space for fintechs that serve advisors, is a very, very, very attractive space. A lot of fundamental dynamics for advisors that say when they break away from a wirehouse or wherever they're coming from, they cut their chops on having if they're an RIA, they cut their chops on having their own enterprise. But some of them realize the way to achieve their goals is actually to get economies of scale, which says they may want to merge and engage in M&A. In a lot of ways, the fintech space is fairly similar, which is it's not that hard to put a technology asset out in the market. It is challenging, and it is a many, many, many year journey to make a profitable, viable, solvent enterprise. And so anytime you have economies of scale as a driver in a market, and anytime a market is growing at a significant clip, those are fertile ground for M&A, and I think we're seeing a lot of that now.
You have a lot of experience in M&A. I mean, you spent a couple of years in strategy development, as you mentioned, traveling the world, buying up companies for a public company. So you have probably a lot more experience than the CEOs of other smaller fintechs. So you probably approached. So how did that experience? First of all, how did that experience help you when LLR came calling and said, "Hey, we want to buy you"? Well, how did that change the way you approach that transaction?
Well, I think one things I've learned over the course of my career is M&A is not successful just because the buyer and seller agree to a price. In fact, sometimes that's a recipe, for a lack of success. I think what makes M&A successful is a shared vision of the future, tight cultural alignment, shared accountability, and an understanding that M&A doesn't work just by handing somebody a check. M&A works when there's a check plus strategic collaboration plus shared execution. And so I think the thing I learned through my career is, like a marriage, it's not just about the ceremony, it's about setting the conditions for a successful marriage going forward. And so bringing that to Y charts, we, for the past handful of years, have been growing tremendously fast, but we've been growing tremendously fast while self-funding based on many, many years ago, some venture funding we raised. We've been constraining ourselves based on our cash flow. And we got to some great milestones, revenue-wise, cash flow positive, all those great things. But there's so much opportunity in the wealth advisor asset manager space. There's so much need for somebody to support them and their workflows that we said a change of pace, a capital infusion, the ability to engage in future M&A was going to help us best serve our market. And so that's how we got there. And I'm just thrilled with the partner we've found ourselves married to for a long, long time.
Good to hear. You want to be happy. At least this is still the honeymoon phase.
Yeah, but you know what? If you do your homework up front, I found that with my own marriage. If you take the time to get to know the person you end up going on a honeymoon with, when you come out of that honeymoon stage, it still feels like you're in a honeymoon. And we're in the honeymoon stage with LLR, but I sure do feel good about the things we learned about them over the past 3 to 6 months. That says this is going to be a really nice marriage.
A couple of things. You use the word shared a number of times when you're talking about the transaction. Shared vision of the future, shared accountability, shared execution. Is that something you would recommend to other CEOs of firms looking for funding, that they want to focus on that shared, everything being shared between the target and the acquirer, or are there other tips and tricks or tips and recommendations you'd give to CEOs who haven't been through this before?
Yeah, I think my biggest thing is not all checks, and those are physical checks, not all checks are equal. You can go get funding from somebody who will give you a check and no more than that. Or you can get funding and a check and a partner in a journey that will inspire you, support you, push you, challenge you, and look for the latter. It's easy to get checks, but that's no big success. There's so much capital being poured into our space right now. The check is the easy part. The success story after the check is what's really important, and just never lose sight of that. And if you're thinking of raising a round of venture capital, or you're thinking of taking on some angel investors, don't limit your scope to, wow, I got a check. Say, what am I getting in addition to that check?
And finally, last but not least, on our end of the year roundup of the best clips of 2020, we have my friend and super entrepreneur, fintech guy, Aaron Shum, CEO and founder of Vestwell. Vestwell is Aaron's second startup. His first one was very successful, Folio Dynamics, which was bought and sold twice. Finally ended up at InvestNet, which they then enveloped it and sucked it into their overall infrastructure, so it doesn't exist anymore. But great company that did a lot of good things in financial services and wealth management, building out technology for Folio Dynamics. And then Vestwell has been killing it, just doing great in the retirement space, building out what people have called a robo-retirement, robo-record keeper. As Aaron says, he doesn't care what you call us, as long as you work with us. Great little clip from Aaron talking about how they are really changing the market for employer retirement plans. And this is really important because retirement is something that a lot of companies don't handle well. It's been clunky. There's been a lot of paperwork involved, and they're not really efficient. So I think that Vestwell's got a great platform to help employers not only save money on their retirement plans, but provide better options, better tools, better financial success for their employees. So please check out this clip with Aaron Schumm. Cool. So that leads, your mention there of that mention leads us right into the survey. So can you explain what the difference between the multiple employer plans and the pooled employer plans for those of us playing at home who don't know those terms?
Yeah, and I'm gonna, hopefully I don't reverse these, but the overall idea is right. It's creating a plan construct, a plan design, with a set of investment elections and matches and so on, where everyone is pooled, right? You have a leading sponsor, right? Someone that acts as the plan sponsor across the entire MEP structure. The PEP I'll come back to, and what they'll do is everyone kind of piles into there, right? Everyone gets the same plan. So it's been around for 20 plus years, right? You see, actually, if you really kind of look at it, it goes all the way back to like the pension era, right? And how those work. But in the multiple employer plan, what happens if you think of like a PEO, right? Like a Trinet or an EDP or something like that, where they have, oftentimes those are a MEP that you become part of when you invest within their, retirement plan. Now, what they're doing is making it, there's the concept of an open MEP and closed MEP, right? Which talks about, who can actually come in and how those get administered. You can now add more people that are outside of the industry or outside of a structure, right? Where before it would just say, okay, only lawyers can be a part of this MEP, right? Law firms, right? Now it's expanded into where you could add different types of companies into that. So that's happening. They do that because it's supposedly easier for people to administer. I argue that differently. I don't think it is much easier, right? When you look at, if you have multiple payroll providers and that you have to incorporate, if it's just one payroll company, yeah, sure, that's fine because everyone's going to the same thing. But if you have, 1,000 companies and 1,000 payroll companies you have to connect to with it and manage that, it's not as easy as people think, right?
Gotcha.
Now on the backside of this, the PEPs, as well as the MEPs, they goes down to 5,500, right? And instead of having to do a 5,500 IRS filing for every company, they can do one filing. So you basically do an aggregate filing around it, right? Which does make some things somewhat easier. We've kind of taken a different approach where we automate a lot of the stuff that doesn't add a lot of value, but is necessary, right? Maybe you think of like payroll connectivity and eligibility. Those are things, that's what we focus on, right? We have, I would argue the best payroll engine out there, right? And the ability to aggregate and distill information and look for anomalies, calculate eligibility, in microseconds, and getting those things right up front, eliminate all the downstream operational, aspects that kind of snowball into these large headaches for folks, and we catch it all up front, right? And in doing that, things get streamlined. So I look at it, we can offer an individual a retirement plan, an individual company retirement plan that is cheaper than any MEP you could ever find in the marketplace. That's customized for them, that allows them to do whatever they want, right? And grow and change and augment the plan as they need, as the company evolves. So, from our standpoint, now will we offer MEPs? Sure. Yeah, we have a couple MEPs that are coming on now. We'll have some PEPs out there. Like, it's fine. We don't really care, right? We just want to be the engine to help facilitate and change the experience overall and give people kind of what they expect in today's world.
Sure. In your survey, which is called the 2020 Retirement Trends Report, which I'll put a link to on our website, you're showing that 33% of advisors anticipate incorporating these employer plans into their practice. Do you see, is that number low or high or just about right for the industry?
So I think it's a little high, right? And here's why. So as an advisor, right? If I'm a financial advisor and I'm engaging with a business, I don't see why an advisor would want to push a business into a box that maybe they don't fit into, right? And just to alleviate, now you could say, well, there's better fiduciary coverage, there's, operationally it's better, and that's all fine, right? But as an advisor, right, their advice should be providing the best plan design and structure for that business and the employees, right? Because that's, risk is designed for the benefit of employees, right? And the protection of those employees. So I think, people gravitate towards this because they think it's, because it's the new, I guess, the topic of the day or the hot item that people want to say, yeah, I can do that and check, right? But but I think when we see this play out, a few years down the road, I don't think people are they're gonna look at it and say, yeah, I don't get that much out of it, right? So I think it's a little high. And if I'm an advisor, I'd say, I'd want to give my client the best advice, the best plan structure I can, right? And not just, no, that's not saying some people don't fit in that box. There's those opportunities. And I think there are opportunities too for advisors to say, well, maybe I'm gonna stand up a couple PEPs and MEPs myself as a provider to my clients, and then decide, be the air traffic controller as to where they should land.
Seems to make sense. It gives them more options. So let's move on to another area which I wanted to cover on the sponsor side. So why do you think it seems to be that user experience and cost are running neck and neck when it comes to choosing a retirement plan sponsor? Why do you think that is?
Mm-hmm. Well, cost depends on who's going to bear the actual fees, right? And it could be the sponsor themselves, it could be the participants, or it could be split, right? But cost, especially in a cost-conscious world, you want to make sure you're getting the best value, right? And I think that also ties into the experience, right? If as a sponsor of a 401k plan, and we have this awesome 401k plan through Vestwell, as long as that flows well, and I have a great experience as the HR person or CFO or who's ever managing the payroll to get ingested into the platform, and the participants actually can understand what they're doing and engage in an experience that makes sense for them without having to be a financial expert, it alleviates the headaches for the sponsor, right, as well as the participant. They know what to do, right? It's kind of funny. We've seen a lot of instances where companies have grown, right, where they've come, through like a payroll relationship we have, and they don't have a financial advisor. Most plans do. 93% of retirement plans have a financial advisor attached, right? In just industry statistics, and that's actually grown over time. It's gone from 68 back in, I think, 2008 to 2019, we're at 93%. And Fidelity does a study around this stuff every year, and you can see that. So I think it creates, it shows that advisors aren't going anywhere, and they're becoming more relevant in the 401k world. But for some businesses, not everyone has a financial advisor, right? And then they grow, and all of a sudden the HR person's getting, knock on their door, phone call or meeting request to talk about what they can do in their 401k plan. The HR person's like, listen, I got enough on my plate. I don't want to do this, right? So that's where the experience, I think, comes into play, right? And then we often get asked, like, hey, do you have a financial advisor you could introduce us to? Like, yeah, absolutely, right? We work with thousands. Yeah. So that, I think it just bodes to the fact that you want to create an experience, you want to allow people to make confident decisions, right, without having to be experts in that field, right? The employees of any business they shouldn't have to be 401k experts or investment experts. So if we can solve for that, we're doing our job.
So you mentioned something interesting, that people are coming to you, Vestwell, the provider of the underlying technology, and saying, hey, do you have an advisor that we can talk to? And that's usually been an area, and that gives you a whole referral stream to your advisors, which has been an area that custodians have kind of try to make their own, like, hey, join our little network, we'll give you referrals. Is that something you're seeing as a benefit of advisors coming to the Vestwell network?
I mean, we don't do it for, we're not doing it as a money-making thing, right? I know there are payroll providers, right, that use this as like a revenue stream for them. Mm-hmm. We're just doing it to help businesses, right? Most of our business is advisor-led, right? Advisor-driven, probably aligning with the statistics of the industry as a whole. But not everyone's the same, and recognize that. So, but it's important for advisors do great things, right? And making sure that they're tapped into this world, and where there's a need, we try to find a fit for them. So yes, so we do it. It's not, but again, it's not like a business initiative that we have. We just, yeah.
Okay. So can we talk about the misalignment of rankings between sponsors and advisors when it comes to measuring success, where they seem to have different ideas of what a successful plan is? Can you talk about that a bit?
Well, so advisors. Well, let me start with the sponsors. Sponsors think success, and this is, in my opinion, right, is when things don't go wrong, right, and you never want a retirement plan to be a headache for someone, right? The challenge is retirement plans are complicated, right? There are so many moving parts in these things, right? And even like, as we built this platform and having, we've been fortunate because even myself and a lot of folks on our team have been on both sides, right? We've been on wealth and retirement over our careers, which you don't see often, which is kind of interesting. But in seeing how things play out on the wealth side, and then looking at the complexities of retirement plan and all the nuance around, just eligibility, right, and the complexities that people have put in place. Now, I think some of it's been made overly complex, right, for whether because people wanted to, scare people into doing certain things, or laws just got in the way. So kind of unwinding those things and distilling it and back to the point where we're trying to take the complicated stuff that's low value add and streamline it becomes important. So if you do that for a plan sponsor who's ultimately the client, right? They're the mutual clients at the end of the day. You want to make their life easy, right? You don't want to be like, oh, I got payroll again, then I gotta go do this, and this is going to take me 2 hours to process, right? You want it to happen right away, and as easy as possible. So we focus a lot on that, and I think that's important, right? On the advisor side, right? They want good. It depends on the advisor, right, and how far they want to go into the equation. But advisors just want to make sure their clients are taken care of, right? Because if they're not, it's a reflection of the advisor who recommended, to use this sort of structure or this sort of program. So you want to make sure that's aligned. So I understand why where the respective sides are coming from with it, and which makes our job, that we have to solve for it all, right? Keep the plans clean, keep them happy, keep them moving, create the experience you want, and make sure it doesn't get screwed up, and then make sure that the advisor's clients are happy and getting what they want, and then then we all win. And it's something we talk about all the time as a business, right? Like our goal is to make sure that every single person that touches this platform, irrespective of who it is, if it's an advisor, if it's an asset manager, if it's a company, if it's the employees of those companies, every person has to be better with Vestwell than without. And that's something we focus on every day.
Hey, it's Craig again. That's a wrap on this year, 2020. Our best of episode is over. Please share this episode everywhere you can. Other people would like to hear it, and any of your friends who would be interested in this, please share it around and send us your comments. Any ideas for people you think we should interview in 2021, please post it on Twitter to me at Craig Iskowitz, or on our website. You can send us a comment there as well. And please remember to give us a 5-star review on iTunes, yada, yada, yada. Have a happy new year, great happy holidays, and see you all next year.